We had the Federal Reserve meeting just yesterday, and I wanted to break down TLT stock. I'm going in on TLT stock. I've already have two levels of purchases, and I plan on pushing a lot into TLT stock. The reason is simple. The Federal Reserve, their next move will be to lower interest rates. But, and this is a huge but, there are two things to think about when you're looking at TLT stock. First and foremost, there's probably going to be a lot of extra supply. The U.S. economy is starting to slow down. That will mean less receipts for taxes, which means more supply. This will artificially push price lower, which pushes yield higher. At the same time, the Federal Reserve, I do not see them having the capability of lowering interest rates prior to November 5th, which is the presidential election. They are not going to want to look like they're swaying the election in any way at all. They may talk a good talk, but I don't expect any kind of moves. So TLT stock could dip a little further, and I'm ready to pull the trigger more and more and more. In the meantime, my strategy, I'm always trading options, although on this move with TLT stock, I am buying the actual stock. I will be selling puts till the cows come home. If I have to take positions on those puts, awesome. Because I'm going to be selling these puts under the market. And if the market dips that low, it's basically saying that I'm buying at a lower price. The eventuality is the Federal Reserve will move interest rates lower despite what's going on with supply. That will affect everything when it does. Eventually, however, TLT stock will move higher. Now let's jump in. I want to show you some charts that I'm focusing on. We get non-farm payrolls tomorrow, and I expect it to be a little softer, which will ease some of the pressure on bonds, which means TLT stock is probably going to start its move higher. I do not expect TLT stock to move too much lower based on inflation. Supply of debt, probably. Let's jump in. Here's a look at the weekly chart on the U.S. 10-year Treasury. Now, TLT stock, of course, trades on the 20 plus. But the short-term rates set by the Federal Reserve are the overnight rate. A good proxy between the 2 and the 20 or 30 is the 10. This is the benchmark investment rate, sitting at about 4.65%, 4.62, somewhere in there. Initially had moved lower on the Federal Reserve's moves, but then yields went right back upward. And if you took a look at the stock market today, or yesterday actually, stocks initially spiked higher, then sold off. Here is a look at, this is the iShares TLT stock. This is the chart. And as you can see, it initially spiked higher when yields went lower, but then yields went back up. TLT stock moved lower. I'm in at 87.5. I got pretty lucky, and I thought, I'm pulling the trigger because I don't think we're going to go too much lower. I have $1 increments. I have certain types of buy orders for TLT stock. I'm also going to be heavily selling puts out of the money. So I'm looking to sell like, say, 87.5 given today's price. We're at 88.5 right now. Should we see movements downward back to 88 itself, I'll probably step in and sell heavy on the 87.50 puts, while at the same time, I'll probably add in more long positions at 87 or 87.5. Here's a bigger look at TLT stock, the weekly chart. Supply. If the U.S. federal government can't bring in taxes, there's going to be more supply, more debt, which will burden price, which will push yield, keep yields pushing a little bit higher. But I don't think that's going to be too much of an issue, because a lot of what's going to happen is you're going to see a shift out of equities, because we already know that the Federal Reserve is going to lower rates at some point in the future, that they're probably done raising interest rates. Given that, stock market today is looking soft. Because of that, a lot of equity traders, the savvy money, will flight to quality, get out of stocks, go into bonds. So although we might see a little more supply on treasuries, you're going to see more demand as well. So that's kind of a balancing thing. I had a conversation with one of my guys out of Chicago, and we were talking about that, and I said, I could see it being an issue, but not that big of an issue. People are going to exit stocks and get into bonds, pushing up price, bringing yield, keeping yield lower. So I think I'm pretty much picking kind of close to the bottom on this move. I think the moves we saw in October and November were artificial and imbalanced. Moving forward, non-farm payrolls, we get this tomorrow. I expect continuing softness here. Take a look at SBUC stock. Starbucks dumped 15%. Why? Orange mocha frappuccinos. People are cutting them out of the budget. Interest rates are too high, too long. So companies are not going to be adding more and more employees on a continuing basis. We'll start to see movements lower in non-farm payrolls. From there, this will pretty much signal that the damage that the Federal Reserve is doing to the economy is starting. But I don't think they will stomach moving prior to the presidential election. Here's the unemployment rate. We might see unemployment rate moving back up above 4%, maybe as high as 4.25 prior to the November election. It used to be that 5% was considered full employment. So at 3.82% where we are currently, this is way beyond full employment. Because of that, the transitional employment, price pressures are still too high. We're seeing price pressures. If we continue to get inflation numbers at exactly the same month-over-month rate, we'd be looking at 4.5% inflation. So the Federal Reserve is forced to keep interest rates higher for longer. This is, for me, the beginning of all my analysis. Personal incomes. More and more people get on the payrolls. This increases the rate of growth of incomes. More and more people are removed from the payrolls. Same thing. So if you want to follow what's going to happen next in the overall economy, ask the question on a personal level, incomes and expenditures. If we have an expanding economy, incomes are increasing on a year-over-year basis, that will mean an expanding personal expenditures. Personal expenditures, of course, turns into revenues for companies, turns into GDP, which we just got last week, which was slower, but it was still like 5.25%. And I wanted to show, this is personal expenditures versus gross domestic product. Just put a video up on, Monday or Tuesday on this based on last week's numbers. Expenditures turns into basically GDP. Now you'll get business and government in there as well. But the real driver is the ability of the economy to hire or fire individuals more readily than governments. Because of that, following that aspect of our economy, which is over 70% of the economy, will give you an idea as to what's going to happen next. This is how I break down my analysis. We're seeing incomes and expenditures moving sideways. We're not seeing that growth, and I don't see how we can get more growth without any kind of stimulus. And if the Federal Reserve is in a position to keep interest rates higher, that's not stimulus. That's not policy accommodation. They won't be able to move before November 5th. Because of that, we're likely to see expenditures decline. SBUCs, Starbucks stock dumped. No more orange mocha frappuccinos for those that are on the fringe. That's how that breaks down. If you want to follow along with how I'm trading TLT stock, make sure to hit the like and follow button. Also, if you want written content on this kind of stuff, my newsletter, I've been sending out emails just about every single day. There's a lot of transitional things occurring with the economy. My Substack, the link down below in the description. You can pick up that free email newsletter. Make sure to check out some of the other value investing stocks I have up there. Hit the like and follow button. Thanks so much for following along. We'll see you in the next video.